Hello, and welcome to Smart Mortgage Insights. I'm Mandy LaRose.
And I'm Conor Lavinka. Today we're going to talk to you about deciphering a mortgage payment and, in turn, trying to define your max budget. Sometimes when you pre-qualify, your LO is going to be a little bit vague, and it's not something that we intend to do or try to do, but every scenario is different. So when it comes down to it, it's hard to say, oh, you can spend $400,000 with no strings attached. Unfortunately, there's quite a few strings that are attached that we need to pay attention to. So what are some of those, Mandy?
Absolutely. So, yes, when you come in and get pre-qualified, we're going to give you an idea of what you can spend, what that's going to look like, what those numbers are going to look like. But like Conor said, it's a little difficult to say, okay, you're going to pay this exact amount for this $400,000 house because there are a lot of things that go into the factor. First of all, you've got your principal and interest payment, which let's talk there for a minute. Your principal and interest payment is, of course, what you're borrowing. So the amount of money that you're going to borrow for that loan based on the interest rate. So that principal and interest payment is going to be your base payment. That's if you're not doing an adjustable rate mortgage or things like that, that's going to stay the same generally forever. So when you come in and we give you a payment, principal, interest, taxes, and insurance, that's what we call a PITI payment. The principal and interest, as long as the interest rate's not changing, is going to pretty much stay the same. But then we start getting into factors such as taxes and insurance, and that can definitely change from property to property, especially here, in areas when you start getting outside, depending on size, value, things like that, that's where your property taxes and things can start changing and insurance start changing as well.
Absolutely. Property taxes are a huge one. Every taxable area is going to be taxed at a rate. And so, for instance, we're here in Anchorage, and in the municipality of Anchorage versus the borough, which is the Matanuska-Susitna Valley, they have completely different taxing rates. The borough simply taxes at a lower rate.
Absolutely.
The next thing is they tax each home individually. So just because the asking price is $400,000 doesn't mean it's going to be taxed at the same rate as the house across the street that's $400,000, because they're going to assign a value to it. And it might be that they assigned a value of $350,000 and the asking price is $400,000. Well, now the taxes will be based on that. It could be that another $400,000 home is assessed at $450,000,
Absolutely.
rendering the taxes completely different.
And what affects that is, like, for example, you go into some neighborhoods, again, in the municipality of Anchorage, you have your typical neighborhoods that, were built in the 2000s. Pretty much every third house is the same house. They just kind of change the color schemes, things like that. You can generally go through neighborhoods like that, and most of those properties are going to be taxed pretty similar to each other.
Exactly.
Unless, there's been some bigger upgrades, remodels, things like that, that are going to change what those property taxes are. But when you start getting into, especially like higher end prices and or custom home build, what a property can be assessed at tax-wise versus what you're going to pay for it can be very, very different. So that's where things get a little bit trickier on trying to determine exactly what that payment is going to be until we know the exact house to be able to pull those taxes and then determine what that payment is going to be. So that's another thing on the taxes. And then we've also got homeowners insurance. So there's another factor that changes things as well. So Conor, can maybe tell us a little bit about how the Conor insurance changes, how that homeowners insurance changes.
Insurance is also very specific to the individual. There's lots of providers out there. I know you're bombarded watching television every day by the different companies saying, please insure with us, bundle with us.
I mean, their commercials are very entertaining.
They're very entertaining. However, their rates are very different, and it depends. Would you like a small deductible? Would you like a large deductible? Would you like to cover more? Would you like to bundle? Ultimately, all these things will really factor in. In Alaska, one of the big talking points is earthquake insurance. It has a tendency to be extraordinarily expensive. and we're not insurance agents, and so
No, we're not.
we're not going to tell you whether to buy in earthquake insurance or not. But what I will tell you is it will really affect the policy premium if you do select earthquake insurance.
Absolutely. And we strongly suggest that when you are looking at homeowners insurance, do some shopping around.
Mm-hmm.
Oh, generally always start with who you have your car insurance with, or if you have
Yep.
other homeowners insurance policies.
Bundle.
Yes, you generally get a break for having more than one policy. So start with the loyal person, the person that you've been doing business with. But if you don't get what exactly you're expecting, shopping around, and of course we can always give suggestions and things like that too. So checking out homeowners insurance is important. In some areas, you deal with flood insurance.
That's a big one.
So that's another big one. And on all properties, we have to pull what's called a flood certification. Condos, single family, all properties have a flood cert pulled. And if the property has been in a flood zone in the last 100 years, I believe
100-year
it
floodplain.
is, yes, then you could potentially be paying flood insurance, which again, depending on how much your property is in a flood zone, that insurance can start getting expensive as well. So there's another factor that comes into play also.
Another thing is on a condo. When we qualify you, we don't really care about what your utilities are with gas, electric, garbage, all that kind of stuff. But with the condo, we care about how much the dues are. And so with the dues, maybe they're $200 a month, $250 a month. That is going to be considered in part of your payment. And so we have to make sure that you can afford that. Another weird thing that we've found is the lower price the condo is, typically the higher the dues are.
Yes.
And a lot of times they tend to be a little bit older, need a little bit more maintenance, and so the dues are a little bit higher. And so again, when you want to qualify for a condo, we have to say something like you can qualify for a $250,000 condo with $200 a month in dues. And I know that sounds super specific, but you go out and find a $250,000 condo and all of a sudden the dues are $450. That may put us over ratios, rendering you unable to qualify.
Absolutely. And it's really important, as like Connor said, those dues can vary pretty dramatically from place to place. So when we give you a ballpark of what you're going to qualify, generally, like for me personally, when I qualify someone for a condo, I usually will work off of dues of like 350,000, show them what their max is. Then maybe do dues of 200, show what your max is. And kind of work that way. And not only do you have the dues, but then of course with the condo, you still have your homeowner's insurance, which is less generally because it's usually your homeowner's insurance on a condo is going to be just for the walls in. So when you pay dues, it covers the insurance for the exterior, but then on the inside, you get your own walls in insurance. But then you still have your property taxes, you're paying your dues, and then let's not forget the principal and interest payment as well. So definitely some factors that go into that too.
The next thing that is going to be a big factor is simply interest rates. Interest rates, we're going to quote you, are going to be a snapshot in time. And with that snapshot in time, we cannot lock you into an interest rate until you are in contract. And so if you come to us and say, we qualify you for $250,000 of a condo at $200 in dues per month at today's interest rates. We don't know what they're going to be a month from now. And sometimes it takes a while to
I
shop.
don't know what they're going to be a day from now sometimes. So
Really. And so it's really important to stay in touch with your loan originator to ask them, what have interest rates done? Because they have an inverse relationship. As interest rates go up, your overall approval will go down. As interest rates go down, your overall approval will go up. And so it's super important to be in touch with your LO and ask them that question.
absolutely. And the other thing that can affect it is credit scores too. Credit scores absolutely affect what your mortgage payment is because credit scores can affect what your interest rate is. Credit scores can affect what your mortgage insurance is if you're not putting 20% down. So making sure that you have good credit. And when we say good credit, we're talking like 740 plus. Not that 720 isn't great credit, but that 740, honestly, really to 760 really starts giving you the best benefits of mortgage insurance, fees, rates, things like that as well. So having good credit in this market really pays when it comes to interest rates and also your mortgage insurance as well if you're not putting that 20% down.
And finally, we qualify you based on your financial health at the time. If you're going to buy something the next day, then it's unlikely that your financial life will change. If you're going to shop over 4 to 6 months, maybe 12 months, and you buy a car or you rack up some credit card debt or something like that, then your approval amount can and will change.
Absolutely. It's important that you talk with us. Everyone's adults here. You have to be an adult to buy a house. So we're all adults, but it's important that you have a conversation with us. If you're at your max capacity and you're trying to buy at the top dollar, but you now need a new car and your payments are going up $200 a month, well, that could affect what you're gonna qualify for. But if you're way qualified over what, and you're going to buy much less, then it might not really affect what's going to happen.
Have that conversation with us.
Exactly. And honestly, that's really what it comes down to in mortgage lending is it's all about communicating, not us just communicating with you, but you communicating with your loan officer and letting them know what is going on in your life at big purchases, vacations, timelines, things like that, so that everyone is on the same page and it'll make the process much smoother.
And so please, when you're interested in a home, reach out to your loan originator with the address. Once we have the address, we will be able to define whether it is a single family, a multifamily, a condo. We will look and see if there's dues. We will see what the property taxes are. So we'll have a very good picture of what it is. And so we're always willing to do cost sheets for you and do as many as you like on properties you're interested in, so we can absolutely be 100% sure that you're going to be qualified for it and you'll know what the payment is going into it.
Absolutely.
Thanks for tuning in. Hope this helped out, and we'll see you next time. This podcast is sponsored by Residential Mortgage, LLC, NMLS numbers 167729, 196, 576, and 1820404. Equal housing lender.